Okay. Good morning. Um, I wish to welcome back to this session. And this session is just a continuation of other sessions that we did in the past. But as a matter of recapping, what we have to do today is to discuss the concept of project cost estimation. And this is very important session. It has been discussed in the past, but we just put emphasis to get an overview. And those who miss the class, then they can have their own time to develop skills. So at the end of this, you shall be able to examine basic consideration of project cost estimation. And also you shall be able to examine year zero and significance of year zero in the project, and also determine project revenue and also project cost, as as well as to know the significance of a break-even point in a project. And we may develop some elements to know um, the budget. So these are the very important things. If you know cost, if you know the benefits, you can easily determine your budget for the project during a particular period of time. Um, um, as I said, that uh, this depends on what type of project you are engaging with, and the cost will be derived based on the type of project. Because if you are developing a project related to schools, the nature of cost will differ to those ones who are developing maybe a dispensary or hospital project, or maybe you are developing um, uh, any type of community project. They will differ. They will differ. So each phase of the estimate may require a different estimating inputs and methods, techniques and tools. So this will depend on the project cycle, and also the project planner is focusing in which area. And these are the things that you will need to know. So the type of project, you should know the type of project influence project cost estimation. What is the type of project is this one? And this may vary from construction project, community project, healthy center project, school project, education program project, road construction project, IT related project, manufacturing or industrial project. They will differ. So the cost, the task of cost estimation, it is it is it is very significant, and it requires and prudent judgment, and also you should remember you are not supposed to overcost, you are not supposed to undercost, but it takes a balance. That's why we say, and also there is no single formula that you may use to say uh, this is the right forecast, but all forecasts are based on the assumptions. Which assumptions are you making? Therefore, we say there must be a clear assumptions to help identify actual proposed cost at the end of the day. And all cost will be based on the forecast. And therefore, it is important to make realistic assumptions. You may go to the field uh, to establish the base of your cost, and also estimate the probability at the market prevailing prices and cost. These are the things you do not need to stay in the office, then estimate the cost. No, you must go to the field to identify the actual cost of the items, where the project is going to be located, and the possibility of those estimates with clear assumptions that you are going to make at the end of the day. So we say this project cost estimate approximate a project probable cost. What are the probable costs that you think are very important at the end of the day for you to run the project? So we have some basic consideration when we are looking at the project cost estimation. We say cost estimates should be sufficient, detailed, and constructed to facilitate project financing and enable effective implementation. So you have to estimate those costs. And the detailed cost estimate should be prepared in a local currency units. So we use the local currency units to prepare the cost. And preparing cost estimates in the local currency units will also facilitate project monitoring and supervision, as a project accounting system and financial reports are likely to be maintained in the local currency units, because now you are providing the base for the estimates, and it is where all other accounting information will be deriving at the end of the day. Therefore, it is important you understand, you prepare in a local currency so that you may not create confusion at the end of the day when running the project. So when determining how to structure and present project cost estimates, it is necessary to consider the structure and the capability of the organization, and as well as the accounting system. You need to know, because if it is a government, how are you going to prepare estimates based on the government perspective? If it is a non-profit, how are you going to prepare? And if it is a private, how are you going to prepare? Because the motive behind differ for the government versus the private sector. The private sector needs to look at the profitability. They cannot run a project that they can't make a profit. But for the government, is service delivery. So they will focus. Their focus is on the estimates, is quality service delivery, as well as the non-profit making organization. So what we say, the underlying project cost estimate should differentiate between foreign exchange and local currency costs that are going to be used at the end of the day. And also, you should estimate the issue of contingency that is going to be happening during the time. So cost estimate comprise a project-based costs. You need to know what are the project-based costs, and when you prepare this, we say you prepare on the basis of detailed estimates of inputs by expenditure category for each output component expenditure category and the implementing agency. So you need to have the project-based cost. You need to have the contingency. You need to have any other charges during the implementation of the project that you think will be incurring. Those are the things that you need to consider. You need to know the project scope. You need to know, you need to understand the field visits and other issues that are prevailing in the project. So when you're preparing your project, you need to develop category. You need to develop category. Let me share with you this one. It is important that I share with you. on this category. Um, um, when we develop the cost estimates, what we have is, for example, what you see here, you have the cost category. This is my labor cost. Duration might be a project for 1 month, estimated cost, and the project code and name, you put it right there, but you have what are the cost, the serial number, then you have the item to be filled in here, then you have the skills, then you have the man days to be spent for that activity, and the cost per man day, how much is that one? Then you can have, it can give you the total. This this is also important for you to examine when you have the labor cost category for the period, and it is significant for people to develop this one in the project. And when you develop this one, uh, you have to make sure, if you have this one, um, you know what is the total there. You need to provide extra analysis down here. If you have labor cost being identified in the field, then you have filled all the items required in here, and the skills and the man days and the cost per man day, then you have the total cost. You need to explain, what do you mean by those items indicated there for the labor cost? What do you mean? So make sure you support this table with notes and narrate all the assumptions. You have to explain all the assumptions you're making. You must draw a table to each cost category identified in the project. And therefore, we expect various table and supported analysis of notes, assumptions, and so on. Cost must be accurate, feasible all the time. And depending on the nature of the project, cost measurements, estimates is important consideration. For example, you have to cost, what are the cost per tons? What are the costs per cubic meters? What are the costs for kilometers, uh, radius, square meters, and so on? So you need to spend some times to develop all these type of costs in the project. And when you have developed this type of projects, then um, you know what type of cost are these ones. You have identified the labor cost. You have identified all other costs related to that project. Then what you will have is is for you to go now estimate the total project cost. If you have started assumptions, how much is that one per month? How much is that one per day? Now you need to develop the lifetime, the all cost for the lifetime. You know, the cost, if a project is going to take you maybe 5 years, then estimate 5 years. So you remember, you started estimating your cost based on the monthly estimate. If you have monthly estimate, then what does it mean? You need now to project in terms of annual cost. Now, if you get annual cost, remember, the project can be 5 years, the project can be 10 years, the project can be 6 years, project can be 12 years, project can be 15 years. Now you need to make a clear assumptions, from year zero. What is year zero? What are the key components that you need to include in the year zero? And why those those elements needs to be included at year zero and not year one. So you need to explain all these kind of things at a time. And you need to have proper assumptions for the inclusion of year zero. Year zero is central for planning. Year zero, this is when revenue has not yet started being generated. So you don't have revenue at that time, but you have some cost that that are incurred at year zero. So we use this year zero to make assumptions that are critical before revenue are being generated. And that's why we say year zero. You can assume that is a grace period for you when you are borrowing money from the financial institution. So that is the time when you consider year zero significant, that I will need a grace period of maybe 6 months. I will need a grace period of maybe 1 year. So the inclusion will depend from the assumption you are making and and yourself as a project planner. It is significant. You know what are the items, because in some cases, when you go to other banks, they may start charging you by the time when they give you money, and then tomorrow they start charging you. So you should be aware there are some implications, especially to those projects related with construction related projects. You need to be aware. It is significant for you to have in mind the year zero. So year zero is there. You make assumption for the year 1, 2, 3, 4, 5, and so on. So if you have item for year zero, you need also to consider what are the key issues to be included in year one. When you include in year one, then this means you have clear assumptions. Why do you include in year one? You see, so you need to estimate. What about year two? There might be changes in those years. And one of the key items that can influence changes is when you predict inflation, when you look at your contingency, those and the flow of your staff, because you cannot employ all staff at one time. So you need to make proper estimates, proper assumptions on that one. So that is significant. Then, as I said, you will have year zero, you will have year one, you will have year two, you will have year three, and so on. And when you have all this, this will give you, looking at the table right here, it will give you the cost for year zero, the cost for the year one, the cost for the year two. Remember, a year, it has 12 months. So somewhere you have already derived those costs. And you must explain each items as far as year zero, year one, year two, year three, year four, and so on until you get the total. So you must explain all this. And what we say, all cost categories will be added to the annual cost and summarized in the above table. And then the notes of assumptions you are making from year one to year two, year three, are necessary to narrate at this stage. Strong arguments and narration must be developed at year zero. I think that one I have already said. It is important for you to have a look at that. You can use different approach to predict. You can use a qualitative approach when you are predicting the cost. When you are predicting the cost, you can use qualitative approach or you can use quantitative approach. But by looking at the qualitative approach, you can use this is based on the judgments, the guess about the trend in the cost. that you think it can be included in your project. So with the qualitative, it means you use expert opinion to get those assumptions regarding the cost. So you can predict, you can predict based on the experience, and so on. So with the quantitative, what we say here is you will have to apply so many variables. So you can use the regression, you can use the trend analysis, you can use the average if you want. There are so many approaches that you think you can use for prediction about the future cost if you want to. So in some cases, a computer can help you to detect the trend for the future. You can establish that one, even if you apply Excel with assumptions of, especially for those projects that are so huge, project of 20 years, a project of 15 years, you might not be accurate when you are using the normal prediction. But when you use computer, you press that function in Excel, then it will give you the trend. At the end of the day, you will have some. You can use the regression to predict the future cost of an item. You can use Excel. You can use the regression. Regression is very important for you, and the other approach that are valid for estimation, that will give you the quantitative approach when you are predicting a bigger project that will take about 20 years and so on. So you need to use some mathematical skills to predict those ones. But for these small project of 5 years, most of the time you can use your qualitative approach. That is using your experience, going to the field. You can ask some people. People can give you opinion, and then you do the best judgment of it when you're running your cost. Um, that will be on the side of your cost, and also once costs are done, it is easier for you to start looking at revenue. It is easier for you to start looking at revenue. Um, this revenue is very important. Uh, This is this is the area where if you don't become smart in estimate, it becomes difficult for you to run the project. As I said earlier, that if you have all the cost in the project, if you have all the cost in the project, then what you will have at the end of the day, it will help you to determine the future revenue that needs to be generated in the project, unless otherwise it is a non-profit making project. But most of the time, if for a sustainable project that it has some elements of selling, then it is important for them to get hold how much will be the price. If these are the costs that needs to be covered, what should be the selling price? What should be the quantity to be produced? What should be our revenue? So in order for you to get revenue, it is quite simple. You just get price multiplied by the quantity that is expected to be generated at the end of the day. So you can estimate your revenue on daily basis. You can estimate your revenue on weekly basis. You can estimate your revenue on monthly basis. You can estimate your revenue in terms of annual. So you can estimate all these things. It is important you have proper assumptions for you to estimate. If you have maybe it's a manufacturing industry. You should know how much quantity are you going to produce per day, and how much quantity are you going to produce per week, how much quantity are you going to be producing per month, then per year, and so on. So um, when doing all this, we say this, you it must be accompanied with clear assumptions. Clear assumptions. Make clear assumptions. And if your assumptions are not clearly defined, you get stuck when forecasting your revenue. So you must develop that one. Uh, Revenue can be, in other words, can be your benefits. Revenue can be your income. And for a non-profit making, will use the word income, because you will have to predict the income flowing from donors. How much is that going to be? But for a business entity, they will talk in terms of revenue to be generated, or in terms of benefits. What are the benefits? Then they quantify. They must produce a particular unit to cover cost, to cover running cost. So you will realize it is significance. But for non-profit making, what, or maybe the government, they may say these are donation. It is income. They will use the word income, donation. It is grant. It is aid or donor funding. You see, all this will depend on the type of the project in mind that require you to forecast during a particular period of time. So, how do you forecast the revenue? When you look right here in these slides, you will see a project can use previous experience to estimate current revenue. You can use previous experience. You may look at competition to help estimate revenue. You may look at estimates how many items are expected to be sold per week and get the average price per items, you see, and so on. So these are the things that at the end of the day, you will have to look at. Estimate the worst scenario case, and also estimate the better scenario case, and make assumptions. And you also need to explain those assumptions. Identify revenue sources and items for the project. Establish revenue for each item. Get the total revenue at the end of the day. So what you will have, this is very similar to what we developed from the cost estimation. So you will have estimated total cost revenue at, and you will have revenue, you will have year 0, 1, 2, 3, 4, 5, 6, and so on. Then this will be at year 0, most projects, you cannot start today and start generating revenue. But otherwise, if it is very small projects of, trying to generate some income, buying and selling, those one, you can do that. But for bigger projects, we are talking of at year 0, you need to develop some infrastructure. Then once the infrastructure is done, maybe you go for farming project. If it is a farming project, year 0, what do you have? You have not started harvest. It will take you some times to start getting the harvest. The harvest may take you 3 months. The harvest can take you 6 months. So revenue at year 0 must always be negative, and unless special assumptions prevail for you to bring in revenue at year 0. So you will see at year 1 how much you have, at year 2 how much you have. Now, the difference between year 1 and year 2 is being inflated by inflation. So you must explain those changes, and it should not be constant, because inflation affects the project. So you must support analysis. So your table must be supported with those analysis. So we say Our cost category will be added to the annual cost and summarize in the above table. The notes of assumptions you are making from year 1 to year 2 is important for you to narrate. And we say strong arguments. Narration must be developed at year 0 on whether you expect to generate revenue in year 0 or not. So you need to have stronger arguments about that one. So what we say here again for you to note, it is important after you have identified all your cost, expenditure, and your revenue or sales, it is easier now to develop the following projections. You will have to develop your cash flow. You will develop your working capital requirements. You will forecast income statements. You will also forecast statement of financial positions, the balance sheet. You will also forecast the budget. So you need to have stronger arguments when developing cost in the project. And it's not a faster item. Get enough time to explain or to derive your cost. Get enough time until you are satisfied. And that is going to be the base for your project. Never overcost, never undercost. It takes a balance from the project planner. But again, there's no single formula that will be used to start estimating. So what we say is the more you start doing it for the year 1, for the first project, the more you gain experience. So remember, when the costs are accurately estimated and the revenue are accurately estimated, it provides the basis for other financial information to be generated very accurately. So you will find those informations like in the cash flow projections and income statements and the balance sheets are going to be derived from the same items. It's just the matter of arrangement. Remember, right here, we are not intending to become an accountant, but we want to predict the future flow of our projects, budget, and other items. Like we want to know how much profit is going to be generated at the end of the day. So these are significant for us to develop. We say this in terms of revenue and cost. Forecasting project revenue and expenses during the startup stages is very important for you to examine. And many planners complain that building forecast with any degree of accuracy takes a lot of time. Time that could be spent selling rather than planning. So you have to plan. No any other investor who is likely to join your project if you cannot provide a set of thoughtful forecast with realistic assumptions. No, you cannot get investor on that one. Therefore, it is necessary to compare project cost and your revenue. And project revenue sometimes is known as project benefits. I think this one I have already said earlier in our discussion. So at this juncture, student, you can take the activity. One of the activities is this one: identify project cost of your choice from year 0 to year 7, and you are required to do the following: determine cost from year 0 to year 7 with their total, determine project benefits to be generated during the period, compute generated project benefits in each year, draw table showing summary of the above item, and make analysis about the table. So this will be your homework. Now, for manager, needs to understand what is the break even, at what particular point a project will break even, and he or she needs to know that which output is strategic for production, which output that once he produces, at the end of the day, the company may start realizing revenue, or which output will cause loss. Now, the loss producing output is also significant for a project manager to understand. And when he knows this, then it leads to the concept of break-even point in the project, and it is important. So, what is break-even point? The level of sales or output where total costs are actually the same as total revenue, and this is known as the break-even point. And it's as I say, it's very important for project manager to know the break-even point. Uh, and this is where we say total revenue is the same as the total cost. Uh, this is very important for you to know. You see, you need to know the loss maximizing region and the profit uh, output that you will be, the quantity that will give you the profit, maximum profit. So you will need to know that one as a manager. You need to know that one as a manager. So this we apply this one so that we can be able to know the loss zone and also the profit zone, and that's why it is important for any project to be included, especially for those that projects that has some elements of profit making. Uh, this is significant for them to understand. And this is the formula on how we can use to compute the break-even point. When you are computing the break-even point, what you will have is the fixed cost of a contribution. The contribution meaning that it is selling price per unit minus variable cost per unit. That will give you your break-even uh, point. So once you know how much is the selling price per unit and how much is your variable cost, then you can determine that one easily. Um, uh, this is one of the example. Fixed cost is 166 and the variable cost is 19.5 and the selling price is 15. So compute the break-even point. So you can do that one. Another activity that you can do that one by yourself is Joseph Moifwani is a small producer of banana in Irungwe. He's a fixed cost 60,000 and the variable cost 40 per units. He sells the banana to local authority across Mbeya region for 100 each. Now required compute break-even point for Joseph Moifwani, a producer of banana. So you need to compute that one. So that is another activity you can do. Um, Also consider the following. Know the computer factory has the following cost. Fixed cost is 10,000. Variable cost is 2. Selling price is 7. Required, calculate the break-even point in units and the break-even points in revenue. And that is the answer on how you can compute. That means you will have 10,000, 7 or over 7 minus 2. That will give you 200 units. And also in the revenue is 200, 2,000 multiplied by 7. This will give you 14,000. So these are the assumptions. The total revenue, you can use the total revenue total cost approach. This is another approach that you may find yourself using. And what you need to do in here, you need to identify what are the fixed costs and what are the variable costs. The fixed costs, they do not vary with the output. They are fixed. And the variable costs, these are varying with output, you see, and you should know that. So the total cost is equal to fixed cost plus variable cost. This will give you the total cost. And the total revenue is equal to price multiplied by quantity. Price multiplied by quantity. So if you use that one approach based on that one, you can have, for example, the inputs, and then you have the total fixed cost, the total variable cost in this scenario. Then you have the total cost, the total revenue, maybe in this context, the selling price was 4 shillings. How much is the profit or loss going to be generated? Now, given this scenario where you have the total fixed cost 2,000 fixed throughout, and the total variable cost like that, as you see, they vary with the output. You see here you have 0, 4,800, 1,200, 1,600, and so on until you get your 4,000, and you have the total cost. And remember, total cost is equal to total fixed cost plus total variable cost. It gives you the total cost. Then the total revenue is equal to, remember, price times quantity. This gives you your total revenue. So this is the example that we have. Then we'll have either you produce loss or the revenue at the end of the day. Now, you can use the same information to put in a chart. You can use the same information you can put in a chart, and where you will find on this side you will have the point where there is output, and on the left hand side on the graph you will have the cost or the revenue, representing the cost or the revenue for the graph. And also on the underneath here you will have the output as usual, and the fixed costs are going to be fixed throughout. And what will be your total revenue? The total revenue must be increasing. And what will be your total cost? Of course, the total cost must be above the fixed cost. So you will see, this is when you plot those costs that have been generated in here, will give you this picture when analyzing your chart. When analyzing your chart. Now, this is important for you to understand. Another review questions for yourself is critically discuss the main limitation of break-even point in a project. So you have to develop that one by yourself. Now, as I said earlier, it is important we estimate our cost properly, and it is also important we estimate our revenue properly, and that will give you the base for financial projections and other projections. So if we have not identified our cost properly, if we have not identified all our assets, if we have not identified all our future liabilities that are going to be, if we have not identified the human resource needed in the project, it will be difficult for us to develop a project budget. So a project budget also, it will be is significant for us to start looking at, and it is based on those assumptions that we have already said, and I will not repeat about that one, but you may concentrate. And also what we say, this is just a financial plan. It is prepared and approved prior to the budget period, and may show income, expenditure, and the capital to be employed in the project. So it is important. It can be for the project, it can be for the department, it can be for the functions, it can be for the productions, and so on. Many people are not planning budget properly because they plan something that is not undeliverable, and they have no link to the strategic plan, and and also the allocation does not reflect priority in the project, and that's why you find most of the projects have some problem. At the end of the day, you realize that they cannot spend as per budget. So after saying that, what do you need to do? You will need to understand that the budget has some setting tips. Number one, you will have the timetable. Number two, you will have your budget headings. And also number three, you need to know the budget line items, uh, the estimated costs, the inflation, forgotten costs, and you must explain all those assumptions that you are making, all those assumptions you are making. You must explain uh, this one. You must explain. So um, at the end of the day, what you'll have when preparing this one, let's look at this. You will have the objectives, estimated revenue, descriptions. You will have the quantity. You will have the unit cost. How much is the amount? Then this will give you a total cost at the end of the day when you're preparing this one. So you will have your estimated revenue, and you will have your estimated cost, similar to what we have said, but you'll have the quantity, the unit cost, then you'll have the amount, and then you have the total cost. So those are the issues that are important when developing your budget, the key components that when you are developing your budget, you must have the quantity, the unit cost, and also the amount that will give you the total cost. But description of your items over there is important. What is that all about? You see, what is these items? How do you describe? You see, and then similar to the cost descriptions, you describe your cost, you see, and also um, you'll be required to prepare your estimate budget for years, depending on the project period. And this will, in a project, will serve as a master plan, a master budget. So it is important you prepare this one based on the assumptions that you are making. In next session, we will again reflect some example for budget. But for today, we may stop here until we meet again next time. Uh, thank you. Thank you. Thank you very much. Thank you very much for today. And thank you very much for your uh, participation. Thank you.